January is one of the best months of the year to establish long-term option positions because capital flows reset, trends begin forming, and implied volatility often dips before rising again. This makes it an ideal time to build leaps positions for the new year's biggest moves. The first strategy is buying leaps on stocks with strong, confirmed long-term trends. Look for weekly uptrends, strong fundamentals, and clear institutional support. Target 9 to 15-month expirations and lean towards 70 to 80 delta calls for stock-like behavior with far less capital. The second strategy is pairing leaps with short-term call selling, the poor man's covered call. You buy a long-term deep-in-the-money call, then sell shorter-dated calls to reduce cost and generate monthly income. The third strategy is using leaps as a stock replacement on high-priced names. Instead of tying up thousands in shares, a LEAPS contract lets you participate in long-term upside with defined risk and dramatically less capital. The fourth strategy is hedging your LEAPS into Q1 volatility. January and February bring major catalysts like CPI, earnings, and Fed meetings. Using protective puts or debit spreads helps protect your long-term position from short-term pullbacks. The final strategy is using a precise LEAPS entry checklist. Low implied volatility, strong trend or catalyst, 9 to 15-month expiration, a 70 to 80 delta option, a clear exit plan before earnings, and optional hedges or income overlays. January gives traders a rare opportunity to build long-term positions with long-term edge. Position now, and you'll be ready for the new year's biggest moves. Thanks for joining us. Don't forget to like and subscribe for more options trading content.